All right, what is up, and welcome back, everyone, to another episode of the Long Game Podcast. I'm your host, Thomas Kopelman, and here with me is Brad Caswell. Brad is somebody that I got connected to recently, and so, Brad, just so you know, typically in the beginning of this, I'm like, hey, everybody, here's my new guest. You probably saw them on Twitter. For Brad, Brad's actually not somebody that I found from Twitter. What ends up happening is, I have a lot of business owners. I have a lot of clients who are, maybe they have private assets, maybe they have a business that they're going to sell, and they want to be able to donate it. The problem is it's not as simple as a typical donor advised fund contribution, right? The average person's like, hey, I got some Tesla stock. It went up a lot, obviously neglect this last year, and I want to donate it. I want to get the tax benefit. Pretty simple, right? We'll still talk about the benefits, all of that. But when you have your own business or a different private asset, it is not that. So I got connected to Brad. He's kind of the go-to resource in this space. And so I'm excited to talk about it. But Brad, how about before we dive into it, you just give a quick overview, kind of who you are, where you work, what you do, and then we'll dive right on into it.
Absolutely. So I cut my teeth on the DAF world as the chief operating officer of Vanguard Charitable for 12 years. So I learned from a big company and learned about transaction-centric items. I learned about customer service in DAFs. I learned about compliance in DAFs and how they have to work within the IRS guidelines. And I learned a lot about the difference between financial institutions and who they are beholden to up in Wall Street and FINRA versus the world of donor advised funds and charities that are beholden to the IRS. Very different worlds and often conflicting in some ways. So I think a good background. And since I left Vanguard Charitable a couple of years ago, I've been freelancing as both a consultant in the DAF space to organizations that want to create their own DAFs or get better at it, with donors who want to ask this question of should I open a DAF, as well as partnering with a group out of Jacksonville, Florida called Charitable Solutions, who is the largest probably organization, charity in the country that accepts complex illiquid asset gifts. So we accept real estate, we accept business interests, we accept crypto, we accept oil and gas, we accept collections of things. There seems to be a run on gold coins this summer, so we've had about 5 donations of gold coins and so forth. And it's a fascinating world. No two gifts are the same. No two donors are the same. They've got different motivations and so forth. But what's fun is I'm talking to good people every day who want to do good things, and you just have to find a way to say yes to those people who want to change the world in good ways. So it's a great gig, and I'm having a lot of fun with it.
I love it. Well, let's start off with why a DAF? What is a DAF? Why is it a good tool? Why do people consider it?
So donor advised fund, DAF, is something that's been around for, gosh, I lose track, but 90 plus years. And it's, in the simplest of terms, we like to refer to it as a checking account or a savings account for philanthropy. So you've got an IRA, you got a 529, you got a regular savings account, you got a checking account, and this DAF thing is a savings account for philanthropy. You put a donation into it, and it can grow with appreciation of the investments you make in it. And at any time, you can request that a grant be issued from your DAF sponsor, from your DAF account to a charity anywhere in the country. And 9 times out of 10, even 99 times out of 100, the DAF sponsor is going to say, yes, I'll be happy to issue that grant for you. And the charity writes the check out of your investment account off to charities all over the country. Very simple, allows you to keep all of your giving in one place in front of you on a simple technology platform. It says, here's all the money you've given us over the year, and all of that goes to your tax benefits somehow. And here are all the grants we issued out to various charities, and we're happy to issue another grant at any time. But it allows you to be organized with all of your granting and charity work across the year.
Yeah, I love that. That makes a lot of sense. And I think, for DAFs, there's a lot of really great benefits for it. I think one of them is, taxes and charity typically go hand in hand, right? You're like, okay, I give to charity, I get the tax benefit, and I give to charity at the exact same time. But there's a lot of people in here that have special timed events that make them want to not have to keep the two together, right? They want to be able to get the tax benefit this year and then have to think about where to donate it from. Because imagine you have no idea capital gain event could happen in the next 3 5 years, no idea, and all of a sudden it's going to happen right now, and you're like, it's November, and now I have to figure out what charity I want to send this to get the tax benefit. That's a lot to figure out. So the coolest thing about a DAF is you get to donate first and then distribute later. That could come this year, it could come next year, it could come 5 years from now, 10 years from now. You could basically pass it on, right? So you get that really good benefit. I think that's one. The other part about it too is, with the higher standard deduction today, less and less people itemize, right? So new tax bill, 31,500 is the new amount that you can take as a standard, or if you get above the standard, you can deduct it. For a lot of people, right? If you're middle income, or you have a mortgage that's a low rate or no mortgage, it's pretty hard to cross that number. So for a lot of people, when they donate to charity, they don't get any tax benefit. So imagine I have 10,000 of state and local taxes, no, nothing else, no mortgage interest. I would need to donate 22,000 to charity to only get a $500 deduction on it. So this creates this issue of, okay, well then what do I do? Well, the donor advised fund lets you lump this into a year. So if you said, hey, instead of giving that 20,000 a year, I'm going to give 100,000 every 5 years, and I'm also going to give stock or give an asset. So the benefit now is, okay, in that year, I have 110,000 of deductions. So now I'm way over the standard. I benefit. The next 4 years, I'm going to take the standard. Versus, hey, I barely get no benefit above the standard. So tax-wise, you come out significantly ahead. And on top of that, you get to avoid that capital gain. So imagine the person that has crypto, right? You're talking about this. I had 25,000 of Bitcoin worth $100,000. I get to donate that crypto. I also avoid a $75,000 capital gain. And for a lot of the clients you and I are working with, they're paying 23.8%. And you would maybe even 37 to 39% if they're in California or New York. So not only do you get the deduction, but you get to avoid that capital gain. And so the DAF allows you to get all of these benefits because a lot of charities don't take stock directly. Some do, more do now, but also you might not want to only do one charity. So the DAF gives you like so many benefits all in one.
That's right. And I think the way I talk to a lot of people about it is that we all have life events. In fact, when one of the surveys we did over the years was we went to a lot of donors and said, why did you open a donor advised fund account? And most people had a life event that happened. Could be estate, could be merger and acquisition, could be
IPO.
they got a house they got to do something with, and whatever. And so that was a big number that they were going to have to deal with. And most charities really don't want to take give them $100,000 and ask them to keep 20,000 and send 4 other checks off to other charities for $20,000 each. Most charities, they certainly can do it. There's absolutely nothing wrong with it, but they're putting in a lot of time for something they're not getting paid for. So that's where the DAF comes in, is taking those big rocks of gifts, putting them in a single place, and then starting to break them up and send them out on your schedule to charities that you want to support. And it could be you don't want the charity to get a $150,000 donation all at once because you're not sure what they're going to do with it, or you want to control a little bit how it feeds into their organization. So you want to be a little more purposeful about how the charities that you're being so generous to are going to manage this inflow of money that they didn't anticipate, didn't expect. So it's an interesting model. Now, that's not to say that there aren't some nuances to all of this. You talked about, avoiding capital gains. Well, there's some nuances to how the math is done there, as you know. You need a certified financial planner or a CPA or somebody on the financial side that understands the tax laws to make sure you maximize the value of what you're giving. You can't just give 100,000 and take a donation value of 100,000 and therefore not have any taxes in a given year. The IRS is going to say there's a maximum limit on how much you can take in a given year, but we'll give you some years to pay that off and so forth. And that's where they'd bring you in and other experts to say, how do I manage this, maximize the value of my charitable giving in a smart way? So it's really, a tag team between the donor, you, and other experts who are going to know how to maximize the value of these kind of gifts.
That's a really good point. So like I think we want to hit on those. So one of them being is that with these gains, it has to be long-term capital gains
That's
first,
exactly right.
right? So if you donate an asset that's at short-term capital gains, you only get to deduct the basis.
That's
You don't
right.
want that, right? You want it to be long-term capital gains where you can deduct the value. The other important part that you mentioned here is you can't drive your income to zero. You're limited on the amount of your AGI that you can deduct. So you can do 30% of your AGI if it's basically stock or an asset, and 50% if it's going to be cash. But, for us, most of our clients that are doing this, it's exactly what you said. What is the time of your life that it makes the most sense? So business owners, a lot of our business owners will take care of the whole rest of their life of charitable giving in the year of their sale. They'll donate right before it. They'll let that money grow and the donor advised fund distribute from there. Another good one is IPO. Another good one is like you have those crypto millionaires, right? Hey, I have all this really low basis crypto. Now I want to diversify some and I already give to charity. So I want to take advantage of that. Inheritance is another one. So for sometimes, hey, I'm already wealthy. I inherited an IRA, and a good way to kind of offset that income is a donor advised fund contribution. We also have times for clients who, hey, I just retired and I want to do a ton of Roth conversions. And so I can use this to help offset Roth conversions and let me not move above the 24% bracket. For example, there's a lot of those just really good ones. Or hey, maybe I started at Meta, for example, and my first few years, my RSU vests are so big that the best time to do it is I'm never going to get as large of RSU vest as that first package. So I think that's another really good time and opportunity to do this.
Right, right, absolutely. And it's the DAF is really built to be that place to accumulate some big gift and then parse it out over time. Now, one thing that's important to understand about donor advised funds, they are a fully legit charity in the IRS. So when you give them your house or you give them part of your LLC, you are letting go of that
Yeah,
asset.
irreversible.
You can't take it back, and that's why they're called donor advised funds. And the DAF is just like any charity. Give money to a Habitat for Humanity or a hospital. You can't ask for it back and say, I made a mistake. Can I get half of that back? That is now owned by the charity, and you got a legitimate tax deduction in the eyes of the federal government and maybe state government, depending on where you are. And so that irrevocability of that donation is important to understand when you make that gift. It isn't, let me try this out and see what happens, and then back it down someday in the future. That's generally not going to be a viable way that any charity is going to work with you. So
Good point. Good point. Okay, so we have two types of assets. We really have private and we have public. So public assets that we want to donate are cash, stock, even some crypto, et cetera. You have some of those companies you talked about that you knew before, right? You have Fidelity Charity, you have Schwab Charity, you have DAFI, you have all these other companies where you can donate. It's not super hard to do, right? You open the account, you donate the asset over. But I think one thing I want to point out here for people to know is not at all of them can you keep that asset, right? So like some of them, if I donate Tesla stock, they require you to get liquidated into funds that they have there. But some of them let you keep in Tesla stock if you want to continue to grow it. So maybe one thing that'd be helpful for the listeners is understanding from your experience, what companies allow you to stay in the asset that you want?
well, it's getting to the point where more are allowing you to stay in the asset you'd like to stay in than not. The dilemma from the charity perspective is they have what's known in the lingo as a fiduciary responsibility not to lose or compromise the value of the assets that have been entrusted to them. So if you give money in whatever form to a charity, they need to make sure they are being responsible, or they could be sued, and it's happened, for mismanagement of the funds that they've been entrusted with. So now your DAF sponsor board has to make a decision about whether holding shares in Tesla is a smart investment decision. Now, a lot of people are going to say it's a good decision. Some people are going to say, gosh, that's a little risky right now. We're not going there. And so every DAF sponsor has to make a corporate decision about how risky their investments are going to be. They're getting more flexible. I'll say that. It's not common for you to go into a donor advised fund and they give you 10 options, and these are the only 10 options: an ETF in bonds, an ETF in stock, and some crypto
Better
ETFs.
than
And
a
those are your
401k lineup.
exactly. So more and more are giving you more flexibility, but that becomes a differentiator. That's why you would pick DAF sponsor A versus DAF sponsor B, because they have a lineup that lines up with your ESG issues or concerns and so forth, where the other one doesn't. But the board has that responsibility. Yeah.
I was just, I think this is important because like I think sometimes people think like why does it matter? You donated the asset, like who cares what you do after? Well, who cares is it should be you, because if you say I want to donate 20k a year and you go donate 200k and you're like great, that's at least 10 years. If you can grow that money over that period of time, let's say 300k, 400k, you either can one give more, or two, you can use less assets later because you can cover more years of giving. So
Right.
a lot of times I hear people, they don't think that that matters, when
Right.
in reality, like the way that I think about it is if you're selling your business and you're going to cover 20 years, could you actually cover 30 or 40 years? Because you almost manage a retirement. You have a short-term bucket, a mid-term bucket, and then probably an appreciation bucket. But the other side of it too is they don't want to take assets that turn into zero, right? So that's why like you can't use these garbage crypto coins that basically turn to zero right away, because all of a sudden you just got this big tax donation for an asset that maybe didn't have that value.
Right.
I'm sure that can run into issues there.
Well, it can. The IRS is certainly aware of the fact that when you donate an asset, not a cash one, but stock or crypto or real estate, that frankly the value of its sale, the sale price of it, is almost never going to be the value of the donation. It's the markets are going to take it up, take it down, whatever. So the IRS is used to the fact that there may be a loss on some donations, there may be a gain on some donations. It's the really severe movement where it goes from $100,000 to zero, um, and you get a tax deduction for $100,000. You got this great thing, but the world of philanthropy didn't get to benefit from that $100,000 donation because the thing had zero value when you were done. Um, so so that's just a fact of life. At Charitable Solutions, when we do this, we're taking real estate. We've got an appraised value of $500,000, and will it sell for exactly $500,000? No, it'll sell for 525, or it will sell for 450 or something. And the IRS is very familiar and comfortable with the fact that these values move around. One other item on the appreciation to be aware of the money sitting in the DAF account, that appreciation is tax-free. That is all free money to give to charity anytime you want. There's no cost to the donor other than maybe some operating costs of the investment firm, expense ratios and so forth, that would be buried in that appreciated value. So you put 100,000 in, and over 5 years it's worth 110,000, 120,000. That extra $20,000 is more money for philanthropy at no cost to the donor.
Yeah.
So
Great benefit.
yeah.
So let's talk about, you want to donate a private asset. So whether this is real estate, this is part of the business you own, maybe you work at a company that is that's private. What's the process? How do I actually go about doing this?
The process may feel complex, but it's actually, in some ways, simple. And I say that because you own a deed to a property, or you own legitimately shares in a business. And the process is simply, I want to transfer those shares or that deed in kind, it's called, to somebody else, to a charity. So there's a piece of paper that says I'm giving 100 shares of my Tesla or my private business or something. I'm giving 100 shares to this charity. The charity accepts them by signing the document. You've signed it over. The charity now owns, in a court of law, the charity now owns those shares and has the right to do anything they want with them. Same thing's true with a deed. You give me a deed to a property in Cape May, New Jersey, boom, it's now owned by a charity, Charitable Solutions or whomever, and it's up for them to decide what to do. They could hold it, rent it, let's say make some money off it. That's part of that fiduciary conversation. But the process isn't too complex. Now, every charity, I will tell you, will want to go into every donation with their eyes open. So if you say I've got 100 shares of this business that's going to take off in the wine making business in Napa Valley, I'm going to want to know do I believe it's going to make money? Do you have full ownership rights to those shares? What are the financials? What am I taking on? So, because now I'm going to be, as the charity, I'm going to be the owner of those shares. What does that mean for me to own those shares? I want to be responsible and purposeful about how I manage that. So I have to do some discovery and research on what it is that's being donated. Once I'm good with it, we'll sign a piece of paper saying we're accepting the shares, and boom, you're you have visibility to an account at the DAF sponsor for the shares that you've given. You'll watch them sell or not sell, depending on the DAF software and so forth. Um, but the process isn't too complex. It's really a discovery process that says, do I know what I'm getting? Do you have the right to give it to me? Are there any restrictions or other things that I need to be aware of? And once everybody says, yes, it looks clean, it's a piece of paper that says, I'm assigning the rights over to this charity, and they accept them.
So that's like, part one, right? So like, hey, I'm about to sell my business. I'm gonna work with Brad. We're gonna take some of these shares. Get the appraisal, get the value, get that
Hmm.
donated into the donor advised fund. But that's only step one, right? Now I figure out like how does that then end up getting to the charities I want? And I
Right.
think, it's easier if it's my business and I'm selling it, in 3 months. Like, of course, cash is coming, that gets liquidated. But if it's a private company or real estate or whatever, like, so me and you work hand in hand, or you and I work hand in hand to decide when the right time is to sell based on triggers that become available.
That's right. And we um, charities aren't experts in all of these businesses that get donated or offered to them. They need you as somebody who's familiar with the business model to understand whether the time is coming to sell. Is there a buyer in the market? Should we wait another 2 years because that's when the IPO is going to happen and so forth? So the charity often is going to turn back to the donor for some insight. The donor doesn't have any control, but certainly any information and insight that I can get from the donor to say now is the time, put that thing out on the market, is helpful because I want to maximize the value as much as the donor wants to maximize the value. So I now have it. But if it's a piece of property, hey, I got to mow the lawn. I got to make sure the taxes are paid and the HOA fees are paid. I got to make sure the driveway is plowed and so forth. There are costs associated with your owning it or me owning it, and those don't go away. It's just you've got to be smart and manage these assets when they come in.
Are there any time frames to know about? Like, if it's my private business I own, do I have to worry about any period that it has to be liquidated?
No, there's some requirements about holding properties for more than five for us to hold properties for more than 5 years if it's not part of our business model, and so there's some reporting to the IRS and some accountability that we have as a charity. There's also um, some there's one sort of gotcha at the front end of the process that everybody needs to be aware of, and that is that the donor cannot pre-sell the asset. If your next door neighbor wants to buy your property, you can't strike a deal with the next door neighbor and then go donate it to us or a charity and then have the pre-arranged price and deal already struck for the neighbor to buy the property from us.
And that's the LOI with business owners, right? Like, you cannot have an LOI. That's what a lot of times business owners like. I want to know I have a buyer before I donate. But what if it doesn't happen in this year and blah blah blah. But the issue is, as soon as you have an LOI signed, that tax planning is over. You had to do it before that.
That's right. And you may well it's called charitable donation versus an assignment of income. The IRS may say that deal was already struck. It was legally binding. The charity had no independence in being able to make the sell decision. So we're going to disregard the charitable deduction. We're going to make that an assignment of income, whatever came in to the original donor, and they'll have to pay the capital gains tax likely. So it's not a good situation to be in after the fact, and usually they're court cases because people want to fight them in court. So now we got court costs and so forth that go on because people say it shouldn't be an assignment of income. It should be and that's where we try to get in up front and say, how far along is this conversation with your next door neighbor or with your competitor who you've agreed to sell your business to, and make the donation in advance of any legally binding donations.
Yep. And like the reason why this is important again for everybody listening is because people want to avoid the capital gain and get the deduction against income. You can donate it after, but you're not going to get a deduction. You're not going to get the capital gains avoidance. The one other lever you can pull here is, well, if LOI is in hand, you could go do a donor advised fund with a different asset. So you could go to your, stock portfolio. The issue is, low basis business you own, probably pretty close to zero, or any other stock you have is probably not going to have the same multiple of growth. You'll still get good tax benefits. Like, it's not the end of the world, but the important part is if you can donate before the sale, you avoid the capital gain and get the deduction against your income, and that double tax benefit is extremely, extremely big. If you think about, hey, I have a business, I'm in California, I started at basis as zero, I'm selling for 10 million bucks, I want to donate 500K, $500,000 capital gains avoidance for this person is basically 37%, right? So you just saved, 185,000 on taxes, $500,000 deduction against income. You're going to be over 50%. So you're really giving, for about 10 to 20% of that cost. Mm-hmm. That's why it's so advantageous to do all of that at that one period of time.
That's right. That's right. Now, there's another piece to be aware of, and we haven't talked about it, but one statistic to be aware of, and this has been built out by a gentleman, Dr. Russell James out of Texas Tech, who has made statements that cash is not king. And cash, in terms of the asset base that we all have, cash is generally only 5 to 10% of the wealth that you have or I have or most people. So think about it. 10%. Charities are asking for cash gifts, and there's fishing in a pool that's only 10% of the wealth of clients. And if you add publicly traded securities, that still gets you only to 50% of the wealth of people. So there's this incredible pool of assets that is appreciated assets, publicly traded stock, stuff, collections, all of those kinds of things that are all legitimate assets to be asking for from the charity's perspective or from a donor's perspective to say, hey, I've got this wine collection I've been sitting on for 20 years and it's really starting to not smell, but be in a good place for me to donate it. Or I've got this painting I want to donate. I bring those up because the collection kind of items, what we call the tangible assets versus appreciated or capital assets, have also a different math associated with donating a capital asset, a tangible personal asset. So donating a car, for instance, that is at a cost basis generally. And I'll give you a quick story. We took a donation of a gentleman who had an $850,000 car this year, and we were just all gobsmacked, and sort of said, this is fun. And we went back to him and said, you can only take a cost basis donation on this. And it was worth $875 on the open market. It had 2,500 miles on it. And his basis was $250,000 or $300,000. And somebody said, are you sure you know what you're doing? You're missing out on all this capital gains. And he said, look, I've loved this car. It's been part of who I am. But it's time for me to take this and put $875,000 into charity. Because I'm going to take this thing that's worth $875. I'm going to take a donation of $300,000 as my cost basis. That's all I'm going to get, but I'm going to end up with $875,000 of cash in my donor advised fund to support philanthropy. He said, I get the math. I understand it. I want to support philanthropy. I have an asset worth $300,000. And so a lot of the financial advisors are having those conversations with donors about these other assets they've got. The appreciated assets, capital assets, are definitely a great kind of gift to give, but other assets count towards viable gifting too. That one I gave you sort of a real off the charts exception, but a lot of good assets to be giving to charities or to intermediary charities like ourselves who will help get the proceeds. So we talked about how am I going to get money to I'm not trying to play favorites, but let's say Doctors Without Borders or the local food pantry. You make the donation of an appreciated asset to a charity like ourselves, and we're going to turn it to cash as quickly as we can. And now you've got $100,000 worth of cash that we're going to send away to Doctors Without Borders or another charity of your choosing. So that's how you take these illiquid assets, convert them to cash on the charity side, and then get that money over to support the good missions that you want to support.
Love it. Love it. I mean, this has been super helpful. I think at the end of the day, right, DAFs are an amazing tool, right? You get the ability to deduct it against your income. You get the ability to avoid the capital gain. You get to be able to lump charitable giving into 1 year. You can use public assets. You can use private assets. Like, so much flexibility and so much great planning can be had here. So appreciate your time. Before we kind of wrap up, let everybody know best places to kind of reach out to you if they're looking to do kind of any of these, complex DAF contributions.
Sure, I can be found at charitablesolutionsllc.com out on the internet, and any one of us would be happy to help. We also get involved with charitable gift annuities and trusts for people who want to give. We have a number of people giving us real estate, sell the real estate, put that into an annuity, and they've got a life income stream for the rest of their lives. So lots of flexibility and creative solutioning in this space. We do this every day for people, charities large and small, customers all over the country, and happy to help anybody that wants to reach out and just ask questions. No charge for asking questions. So happy to help.
Love it. Love it. Well, Brad, thanks for the time, and everybody, really appreciate you listening. Please don't forget to rate and subscribe, and we'll see you back for another great episode next week.
Good. Thank you.